Dear investors, welcome to our monthly outlook on markets. We intend to cover three important events that transpired in the month of September. First, inclusion of Indian government bond in JP Morgan Emerging Market Bond Index. Second, crude oil that has moved beyond $90 per barrel. And rainfall. While we may have seen some improvement in September, yet it was deficit at an overall level. Friends, inclusion of Indian government bonds has been an important event last month. Inclusion is slated to commence on June 28, 2024 in a staggered manner. From the date of commencement, 1% weight will be added to the index every month for next 10 months. And that will take the overall weightage to 10% by March 25. This would put India's weightage along with weight of China, Indonesia and Mexico all at 10%. This is the event that will transpire after 9 months. Yet, we believe post this inclusion, other global emerging market bond index may also consider taking similar action and add Indian government bond in their index as well. For the country, this is an opportunity to tap a larger pool of liquidity to meet the growing finance need. This event, according to us, can lead to India witnessing inflow of over $20 to $25 billion in Indian bond markets. Over period, though not necessarily in the short period of time, this would bring diversity in India's debt ownership and deepen Indian bond market. Overseas ownership is less than 2% of the total outstanding debt in India. In our assessment, inclusion in the index is expected to bring down the country risk premium attached to it in the global financial market. This should also lead to lower cost of funding and thereby cost of capital and consequently a positive effect on the overall equity valuation. With this inflow of funds in next financial year, it is expected to see a mildly positive impact on the Indian forex reserves and also bring about some additional stability in the currency market. However, while this was positive in the month of September, we also saw crude price going up pretty drastically. Crude price went up beyond $90 per barrel versus April to August average when we saw crude for us at almost $80 per barrel. Compared to the lows reached in June 23, Brent crude is now already up 34%. This is primarily due to supply constraints as Saudi Arabia extended production cuts and Russia to reduce exports. We believe this can lead to shortfall of 3.3 million barrels per day in the quarter fourth of this calendar year. Firming crude prices may remain a headwind for Indian economy in the near term. There can be three major ramifications. First, current account deficit. Every $10 increase in crude price leads to India net imports increasing by $15 billion. If crude remains elevated at $90 per barrel, our current account deficit may go beyond 1.5% of GDP, though high, but it is still lower than the 2% that we saw in fiscal year 23. In the short term, this can still have some adverse effect on the currency. Second is inflation. Every $10 increase in crude price impacts CPI inflation by about 30 to 40 basis points directly, and a similar magnitude indirectly. This, however, assumes that there is a 100% pass-through of the global crude oil prices to the local pump prices. However, in current scenario, the pump prices are being controlled and the pass-through is not only lagged but also incomplete. Third important aspect is about impact of increasing crude oil prices on the margins of few companies. Some sectors like aviation, cement, paints may see some impact of margins in the short period of time. Businesses which have ability to pass on this increase in raw material prices over period can see their margins coming back. In the short term, this can have some detrimental impact on the margins. However, over last few years, India has reduced salience of crude in overall GDP. The share of net crude import to GDP has fallen from 5.6% 10 years back to 3.4% now. Also, our net IT exports today are significantly more than our net crude imports. And sharp rise in services exports should further reduce external macro vulnerability. Friends, monsoon have officially ended and rainfall, though recovered in September, yet overall closed with 6% deficit. On a cumulative basis, rainfall was normal in northwest and central India, while relatively weaker in east and northeast and southern India. Interestingly, though rainfall has a major impact on total agricultural output of the country, the overall impact has been reducing as there has been a structural shift in contribution of crops to agricultural gross value addition. The contribution of crop to agriculture gross value addition has dropped from 63% to 52% in last 10 years. Also, gradually India is increasing irrigation. Currently, 52% of land is irrigated versus 37% 10 years back. This has led to gradual reduction in dependence on rainfall. Friends, overall markets have been buoyant in last few months. We believe markets from here on will be more driven by bottom-up ideation. Those businesses that deliver on superior earnings, backed by solid capital efficiency, should perform distinctly better than the others. Also, earnings season is round the corner. Current quarter will continue to witness capex-driven businesses performing well on earnings front. Global linked businesses like chemicals, IT will continue to report muted results, while pharma is expected to be a mixed bag, with domestic growth being slower, while US-based pharma businesses should continue to perform well. Thank you.